Listen to me very carefully because what I'm about to share with you could be the difference between living your golden years with dignity and confidence or lying awake at night worrying about whether you'll have enough money to last until tomorrow. I'm not trying to scare you. I'm trying to save you from a financial disaster that I see happening to good people every single day. I'm Mr. Wonderful, and I've spent decades in the trenches of finance, watching fortunes made and lost, seeing brilliant people make catastrophic mistakes with their money, and learning what actually works when your financial life is on the line. Today, I'm going to share 3 exchange-traded funds that could literally save your retirement. But first, I need you to understand just how dangerous the retirement landscape has become. Before we dive deep into these life-changing investments, I need you to do something critical right now. Hit that subscribe button and ring that notification bell. Why am I asking you to do this? Because the information flowing through this channel isn't just entertainment, it's financial survival training. Every video I create is designed to protect your wealth, grow your cash flow, and ensure you never become a statistic. And if you're serious about securing your financial future, you need to be part of this community of smart investors who refuse to leave their fate to chance. Now, let me paint you a picture of what's really happening in retirement communities across America right now. I meet people constantly, hardworking folks who did everything their parents told them to do. They saved diligently, maxed out their 401k contributions, listened to their financial advisors, bought the recommended mutual funds, and followed all the conventional wisdom. And you know what? They're living in absolute terror. These good people wake up every morning and check their account balances like they're checking their pulse. They watch their portfolios swing up and down like a roller coaster, and they can't sleep because they know that one bad month could wipe out years of careful saving. That's not retirement, that's financial torture. And the worst part is, it's completely unnecessary if you know what you're doing. Here's the brutal reality that the financial industry doesn't want you to hear. Most retirees are walking around with portfolios that are essentially time bombs waiting to explode. They're loaded up with individual stocks that could go to zero overnight, or they're in aggressive growth funds that are completely inappropriate for someone who needs that money to eat and pay rent. Even worse, some are sitting in cash accounts earning practically nothing while inflation devours their purchasing power like a hungry monster. Every single one of these approaches is a recipe for disaster. And the tragedy is that these people think they're being responsible. They think they're doing the right thing, but they're actually gambling with their survival money, and they don't even know it. You want to know what keeps me awake at night? It's not my own investments. I've been doing this long enough to protect myself. What haunts me is thinking about the millions of retirees out there who are one market correction away from having to choose between their medications and their groceries. One crash away from having to go back to work at 75 years old, competing with 20-somethings for jobs that barely pay enough to cover their expenses. That's not just a financial tragedy, that's a human tragedy. And it happens because people don't understand that retirement investing is a completely different game than accumulation investing. The rules change, the strategies change, the risks change, and if you don't adapt, you get crushed. Let me tell you something that might shock you coming from someone known for aggressive investing. When you're retired or close to it, you cannot afford to be a cowboy with your money anymore. The game has fundamentally changed, and you need to change with it or face the consequences. When you're young and working, market volatility is actually your friend. A crash means you can buy more shares with the same amount of money from your paycheck. You have decades for compound interest to work its magic. You can afford to take risks because time is on your side. Time heals all wounds in the investment world, except when you don't have any time left. But when you're retired, you're playing by completely different rules. You don't have a paycheck coming in to smooth out the bumps. You don't have 30 years to wait for the market to recover from a crash. You need that money now, this month, this year, to maintain your lifestyle and dignity. This is why everything changes when you cross that line from saver to spender. This fundamental shift is why I am absolutely obsessed with 2 things when it comes to retirement money: safety and cash flow. Notice I didn't say safety or cash flow, I said safety and cash flow. You need both working together like a perfectly choreographed dance. You can't just stuff your money under a mattress and hope inflation doesn't eat it alive, but you also can't chase high yields without understanding the risks that come with them. What you need is a sophisticated strategy that protects your principal while generating the income you need to live comfortably. And that's exactly what I'm going to show you today with these 3 carefully selected exchange-traded funds. Now, let me be clear about what these funds are and what they're not. They're not sexy. They won't make you rich overnight. They won't double your money in 6 months. If that's what you're looking for, you're in the wrong place. These funds will never be featured in get-rich-quick schemes or day trading videos. But here's what they will do, and this is why they're so powerful. They will protect you when the market crashes and everyone around you is losing their minds. They will pay you consistent, predictable income that you can count on month after month, year after year. And most importantly, they will let you sleep peacefully at night knowing that your retirement is secure no matter what chaos is happening in the markets. That peace of mind is worth more than all the gambling and speculation in the world. I've made a lot of money in my career, and I can tell you that the best investment returns mean nothing if you can't enjoy them because you're constantly worried about losing everything. Let me explain why exchange-traded funds are absolutely perfect for retirees, especially compared to the other options you might be considering. First, they give you instant diversification. Instead of betting your entire retirement on one company that could go bankrupt tomorrow, and believe me, it happens to companies you'd never expect, you own hundreds or even thousands of companies in a single investment. That spreads your risk across an entire universe of businesses instead of concentrating it in a few individual stocks. Second, they're liquid. You can sell them any day the stock market is open, usually within minutes of placing your order. Try doing that with real estate, which can take months to sell and comes with huge transaction costs. Try doing that with a private business or a partnership investment. ETFs give you flexibility when you need it most. Third, and this is huge for anyone living on a fixed income, the fees are incredibly low compared to actively managed mutual funds. I absolutely hate paying unnecessary fees. Every dollar you pay in management fees is a dollar that's not working for you, not generating dividends, not compounding over time. Fees are like termites. They might seem small, but they'll eat away at your wealth over time until there's nothing left. But here's where most people make a crucial mistake. They think all exchange-traded funds are created equal. They absolutely are not. There are thousands of ETFs out there, and I'm not exaggerating when I say that most of them are complete garbage designed to make their creators rich, not their investors. Some ETFs are way too aggressive for retirees, loaded with volatile growth stocks that can lose 50% of their value in a matter of months. Others are too concentrated in one sector. Imagine being retired and having all your money in technology stocks when the dot-com bubble burst, or in financial stocks during the banking crisis. Some have high fees that will slowly but surely drain your account over time. And others are just poorly constructed products that look good on paper, but fall apart when you actually need them to perform. This is exactly why I spent months researching and analyzing to find the 3 safest, most reliable options for retirees. I didn't just look at recent performance numbers because those can be misleading. I dug deep into how these funds performed during every major market crash over the past several decades. I analyzed their dividend yields and, more importantly, their dividend growth over time. I scrutinized their expense ratios to make sure you're not getting robbed by fees. I examined their underlying holdings to ensure they're actually diversified and not secretly concentrated in risky investments. I looked at everything because when it comes to retirement money, you get exactly one chance to get it right. One major mistake can cost you years of financial security, and at this stage of your life, you don't have years to recover from a catastrophic error. Now, before I reveal these 3 funds that I trust with retirement money, I want to make sure we're crystal clear on the objective here. The goal is not to get rich. If you're already retired or close to it and you're still trying to hit home runs with your money, you're playing the wrong game entirely. You've already won if you've accumulated a substantial retirement nest egg. Now your job is to protect it and make it last. The goal is capital preservation and income generation. That might sound boring compared to stories about cryptocurrency millionaires or meme stock fortunes, but let me tell you what's not boring. Having enough money to do whatever you want for the rest of your life without constantly worrying about running out. That's true freedom, and that's what we're building here. When the next market crash comes, and trust me, it will come because they always do, most people will panic. They'll watch their portfolios drop 20, 30, 40%, and they'll do the worst possible thing. They'll sell everything at the bottom because they can't psychologically handle the pain of watching their life savings disappear. But with the right exchange-traded funds in place, you don't have to panic. You won't be tempted to make emotional decisions that destroy your financial future. You'll know you're protected by diversification. You'll know you're still getting paid dividends even when stock prices are falling, and you'll have the confidence to stay the course while everyone else is running around like their hair is on fire. I've lived through multiple market crashes in my career. I've watched people lose everything because they weren't prepared, but I've also watched people who were smart and prepared barely feel a thing when the financial world was collapsing around them. The difference between these two groups isn't luck, it's strategy. It's having the right investments in place before the storm hits. You don't buy fire insurance after your house is already burning. You don't buy car insurance after you've already had an accident, and you don't build a defensive portfolio after the market has already crashed. You do it now while things are calm, while you can think clearly and make rational decisions. So what are these 3 exchange-traded funds that I trust with retirement money? I'm going to walk you through each one in detail, and I want your complete attention because the specifics matter enormously here. This isn't about buying something just because it has a good marketing name or because some talking head on television recommended it. You need to understand exactly what you own and why you own it. The first exchange-traded fund on my list focuses on what we call dividend aristocrats. Now, if you've never heard this term before, let me explain why these companies are so special. A dividend aristocrat is a company that has increased its dividend payment to shareholders every single year for at least 25 years straight. Think about what that means for a moment. 25 consecutive years of dividend increases means these companies survived multiple recessions, multiple market crashes, multiple economic crises, and they still found a way to send shareholders more money every single year. That's not luck. That's quality. That's stability. That's exactly the kind of business you want to own when your financial survival depends on consistent income. This fund is packed with companies like Coca-Cola, Johnson & Johnson, Procter & Gamble, Walmart, and McDonald's. These aren't exciting tech startups or speculative growth companies. They're boring, predictable businesses that sell products and services people need no matter what's happening in the economy. People still brush their teeth during a recession. They still need household cleaning products when the stock market crashes. They still require healthcare and prescription medications when unemployment is rising. These are what we call defensive businesses. They have incredible track records, strong balance sheets, and business models that generate cash in good times and bad times. And when you own them through this exchange-traded fund, you get exposure to dozens of them in one simple, convenient investment. Here's why I love this fund for retirees. First, the dividend yield is solid and sustainable, typically ranging from 2.5% to 3.5%. That's real cash flow you can count on, deposited directly into your account 4 times a year like clockwork. Second, and this is crucial for fighting inflation, those dividends grow over time. These companies don't just maintain their payments, they increase them year after year, which means your income keeps pace with rising costs. Third, and perhaps most important for retirees, when the market crashes, these companies hold up better than almost anything else. During the 2008 financial crisis, during the 2020 pandemic crash, during every major market correction, dividend aristocrats fell less than the overall market and recovered faster. That's exactly what you need when you're living off your investments and can't afford to see your portfolio cut in half. The expense ratio on this fund is incredibly low, usually around 0.35% or less. That means you keep more of your returns instead of paying some overpaid fund manager to underperform the market. In retirement, when every dollar matters, keeping fees low is absolutely critical to your long-term success. Now let's talk about the second exchange-traded fund, and this one focuses entirely on bonds. I know what you're thinking. Bonds are boring, bonds are for old people, bonds don't make any money. Well, if you're retired, you are old in investing terms, and bonds are absolutely your friend when used correctly. But we're not talking about just any bonds here. We're talking about a specific type of bond fund that focuses on short-term, high-quality corporate and government bonds. Why short-term? Because when interest rates fluctuate, which they do constantly, short-term bonds don't get crushed the way long-term bonds do. They're more stable, less volatile, and they give you flexibility in changing interest rate environments. Plus, they still generate income. The yield might not be as high as riskier long-term bonds, but the safety and stability are worth the trade-off when you're dealing with money you can't afford to lose. This bond exchange traded fund typically holds bonds from investment-grade companies and U.S. Treasury securities, which means you're essentially lending money to the most creditworthy borrowers in the world. The risk of default is extremely low. You're not going to get rich from this fund, but that's not the point. The point is to have a portion of your portfolio that remains stable, generates steady income, and actually goes up when stocks go down. That's the beautiful thing about bonds in a retirement portfolio. They provide balance. When stocks are crashing and everyone is panicking, investors typically run to the safety of bonds, which drives bond prices higher. So while your stock holdings might be declining, your bond holdings are often increasing, which cushions the overall impact on your portfolio. During the 2008 financial crisis, while stocks were getting demolished, high-quality bonds actually gained value. During the COVID-19 crash in early 2020, the same thing happened. This is why every retiree needs meaningful bond exposure. It's not about being overly conservative. It's about being smart and protecting yourself from catastrophic losses that you can't recover from. The yield on this fund varies with interest rate conditions, but typically ranges from 3 to 5%, and the expense ratio is tiny, often under 0.10%. You're basically getting institutional quality bond management for almost nothing, which is a fantastic deal compared to trying to buy and manage individual bonds yourself. Now we get to the third exchange-traded fund, and this is the one that brings everything together in a beautifully simple package. This is what we call a balanced fund. It holds both stocks and bonds in a conservative allocation designed specifically for retirees. Think of it as a complete retirement portfolio in a single fund. For someone who doesn't want to think about investing every day, who doesn't want to worry about rebalancing between stocks and bonds, who just wants to buy one fund and know they're properly diversified, this type of fund is absolutely perfect. These balanced funds typically hold around 30 to 40% stocks and 60 to 70% bonds, though the exact allocation varies by fund. The stock portion gives you growth potential and dividend income, while the bond portion provides stability and safety. It's literally the best of both worlds wrapped up in a single ticker symbol. What I really love about these balanced funds is that they automatically rebalance for you. When stocks have a great year and grow to represent too large a portion of the fund, the managers automatically sell some stocks and buy more bonds to get back to the target allocation. When stocks crash and bonds outperform, they do the opposite, selling bonds and buying more stocks at discounted prices. This automated rebalancing forces the fund to buy low and sell high, which is exactly what you're supposed to do, but most people can't because their emotions get in the way. The fund removes human error and emotional decision-making from the equation, which is invaluable when your financial security is at stake. The returns on these balanced funds won't blow your mind, but they're consistent and predictable, which is exactly what you need in retirement. Over long periods, you can expect annual returns in the 5 to 7% range with much lower volatility than an all-stock portfolio. Most importantly, when markets crash, these funds don't fall apart. They might decline 10 to 15% instead of 30 to 40%, which means you can stay calm and stick to your plan instead of panicking and destroying your financial future. The expense ratios on quality balanced funds are also very reasonable, typically under 0.20%. You're getting professional asset allocation, automatic rebalancing, and ongoing management for basically nothing. Compare that to paying a financial advisor 1% of your assets every year, and you can see why these funds make so much sense. Here's the strategy I recommend for most retirees, and this is critically important. You don't have to choose just one of these funds. In fact, you probably shouldn't. The intelligent approach is to combine all three in proportions that match your personal risk tolerance, income needs, and financial situation. If you need a lot of current income right now, you might put more weight into the dividend aristocrat fund and the bond fund. If you're in early retirement and can afford to take slightly more risk for growth potential, you might allocate more to the balanced fund. The key is building a portfolio that lets you sleep soundly at night regardless of what's happening in the markets. Let me give you a concrete example. If you have $1 million saved for retirement, you might allocate $300,000 to the Dividend Aristocrat Fund, $300,000 to the Bond Fund, and $400,000 to the Balanced Fund. This gives you diversification across different investment strategies and asset classes. You've got reliable income from dividends, safety and stability from bonds, and growth potential from the balanced allocation. When one part of your portfolio is struggling, another part is likely holding steady or even increasing in value. That's the beauty of proper diversification. You're not putting all your eggs in one basket or relying on a single strategy to carry you through retirement. Think of this approach as building a financial fortress around your money. When the inevitable storms come, and they will come because they always do, you'll be protected while others are getting battered by the winds of market volatility. Let me tell you exactly what happens when you don't have this protection in place, because I've seen this tragic story play out thousands of times. The market is doing great, everything is going up, people are feeling confident and maybe even a little cocky about their investing skills. They think they're geniuses because their aggressive portfolio gained 20 or 30% last year. Then boom, a crash hits. Maybe it's a financial crisis like 2008. Maybe it's a pandemic like 2020. Maybe it's something completely unexpected that no one saw coming. Suddenly their portfolio is down 30, 40, 50% or more. And because they need that money to live on, to pay their mortgage, to buy groceries, to cover their healthcare costs, they're forced to sell at the absolute worst possible time. That's what we call a death spiral in retirement planning. Once you start selling investments during a crash, you're locking in massive losses that you can never recover from. And here's the cruelest part. When the market eventually recovers, which it always does throughout history, you don't participate in that recovery because you already sold everything. You got out at the bottom, and now you're sitting in cash watching everyone else make money while you're trying to figure out how to make your remaining savings last for another 20 or 30 years. It's a nightmare scenario, and it's completely preventable with the right strategy. This is why the 3 exchange-traded funds I've described are so critical to your financial survival. They're specifically designed to prevent that nightmare scenario from ever happening to you. The Dividend Aristocrat Fund keeps paying you income even when stock prices are falling. The Bond Fund provides stability and often increases in value when stocks crash. The Balanced Fund automatically adjusts to take advantage of market volatility without requiring you to do anything. Together, they create a portfolio that can weather any financial storm while continuing to provide the income you need to maintain your lifestyle and dignity throughout retirement. But here's what you absolutely must understand about market crashes. They're not rare, once-in-a-lifetime events. They happen regularly. If you're going to be retired for 20 or 30 years, you're going to live through multiple significant market corrections. That's not pessimism, that's mathematical reality based on market history. The question isn't whether you'll face market volatility in retirement, you will. The question is whether you'll be prepared for it or whether you'll be a victim of it. That choice is yours, but you have to make it now, before the next crisis hits and emotions take over your decision-making process. Your retirement security depends on getting this right. There are no do-overs, no second chances, no time to recover from a catastrophic mistake. But with the right foundation in place, with these 3 carefully selected exchange-traded funds forming the core of your retirement portfolio, you can face whatever the markets throw at you with confidence and peace of mind. That peace of mind, that ability to sleep well at night, knowing your financial future is secure, that's worth more than any amount of speculative gains you might achieve by gambling with your retirement money. Protect what you've built. Secure your future. Your older self will thank you for making these smart decisions today.